Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, July 10th. Trump administration continues to reveal tariffs and they look bad and they look inflationary, but markets ignore the risk and continue to price in two rate cuts from the Fed this year, and the rally in major US and European indices is being pushed higher. Nvidia hit the $4 trillion valuation mark yesterday. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So the tariff reveal letters kept coming in yesterday in alphabetic order, and they didn't look enchanting to say the least. Exports from Algeria, Libya, Iraq, and Sri Lanka will be subject to 30% levies. Brunei and Moldovan exporters will be paying 25% levies on their exports toward the US, while the Brazilian exports will be hit by a hefty 50% tariff. So far, the tariff rates range between 25 to 50%, except for the United Kingdom that actually managed to pull itself a nice 10% tariff, and the European Union is still waiting for its own verdict. The latest news on the wire actually suggests that European tariffs could be higher than the UK's 10%, but the markets simply do not care. The Stoxx 600 index rallied yesterday to 550 level, while the US counterparts also had a bullish session. The S&P 500 gained 0.61%, while Nasdaq 100 hit a fresh intraday high, fueled by a more than 2% jump in Nvidia's share price at some point in the session, making the AI kingpin the first company to ever reach the $4 trillion valuation. Now, of course, we can't really say that Nvidia didn't deserve this title, and I frankly think that there is more to come for Nvidia, because the company navigates through trade and politics and geopolitics jungle with grace. Their efforts to replace their Chinese business with other promising partners led by the European and Middle East partners will certainly pay off sooner rather than later, and there is a chance that tensions with China ease and the export restrictions tame. And the company CEO Jensen Huang is also looking beyond AI to robotics to remain a step ahead of the competition. The company also offers an ecosystem to companies who want to take a chance in AI, so it is not a simple chip company, frankly. On the other hand, we are just at the dawn of the AI era. The next milestone will just be this fusion of AI with robotics, a synergy that will give AI hands, feet, and a body, and that is what will truly catapult us into a Jetsons-like future. So it is all very much exciting, and the rally that we witnessed today for Nvidia is not just speculation, and it is not necessarily based on what the company has achieved. A part of it is, but it is also based on what it could achieve more, and the potential is endless. Now, price-wise, Nvidia managed to double its valuation from the April dip. The stock is also up by more than 1,000% since the launch of ChatGPT at the beginning of 2023, the first worldwide introduction between AI and Mr. and Mrs. Everybody. And well, the stock price could experience a period of consolidation, but the outlook for Nvidia remains positive. Valuation-wise, the stock is highly valued, yes, with a P/E ratio that stands near 52, but this valuation is not necessarily shocking either, given that it will probably level out when the next earnings will be announced at Nvidia in a couple of weeks from now. So the next earnings season is going to be strong, probably for Nvidia. They expect to announce a $45 billion sales in the second quarter, which would pull the P/E ratio back to the 40s. Now, note that TSMC's second quarter sales came in just this morning, and they came in higher than expected despite stronger Taiwanese dollar. So yes, I think that Nvidia will remain at the heart of AI, and the positive outlook is actually funded. Yes, trade and tariffs remain a risk, and competition also remains a risk, as a greater adoption of AI could deviate a part of the demand toward cheaper options like AMD, for example. But I genuinely believe that Trump's bring manufacturing back to America policies will certainly and only accelerate AI adoption, as this is the only possible and reasonable way to bring production lines back to America and enter your cause. So the way forward is wide open for better or for worse with AI. Now, coming back to our own time from Jetsons, the news on the wire remain quite hectic, mind you. It's all about obviously tariffs, hatred, chaos, other than AI. But the markets have a fascinating capacity to adopt and digest these news, and the trade news are just becoming the new normal. They are no longer hammering the market mood as they once did. What could still hammer market mood is when all this will start showing up in the actual economic data in terms of lower economic growth and higher inflation. But until then, the music is still on and investors continue to dance. In this respect, Amazon, which had a weak debut to its Prime Day week, is doing not too bad right now, according to Adobe, that hints at a 10% growth of sales in the first day of sales of the Prime Day sales, compared to a year ago, while the latest FOMC minutes that were released yesterday actually boosted optimism that the Federal Reserve will be able to cut the interest rates later this year, come hell or high water. Officials at the Fed have actually diverging opinions regarding the medium long-term impact of all of these tariffs and trade policies on inflation. Some actually want to believe that the impact of tariffs on inflation will remain short and contained, as it will be just a one-off rise in prices, while other members still warn that the tariff-led inflation could prove sticky and would need closer attention and careful policy. I guess time will tell. Now, one thing is sure though, AI and automation will decrease costs, increase productivity, hence could have a positive impact on growth and a taming impact on inflation, which is the Goldilocks scenario, and which is exactly what you want to have as politician or economist. Then, what to do with the people who will be losing their jobs is another question entirely. There will be some period of pain in this transition, but if you look back, if you think back to the Industrial Revolution, the end result was significantly better for the overall society, and overall it was worth it. Now, in the FX and commodities space, the US dollar is losing the early weeks positive momentum on the back of less than ideal trade headlines that we have on the wire since a few days, and also a dovish shift in Fed expectations. The US 2-year yield dived yesterday to 3.85%. Mark. The pricing actually matches with 2 interest rate cuts from the Fed this year, which I believe is probably too optimistic and will not be happening. But opinions actually diverge. The chief economist, for example, at Goldman Sachs thinks that the Federal Reserve will deliver 3 interest rate cuts this year, while Bank of America strategists think that stagflation will be a barrier for ample rate cuts from the Fed this year, and they recommend choosing value over growth, dividend-paying stocks over others, and choose technology stocks wisely by favoring the companies who have neat balance sheets and dividend initiation. This is what they say at Bank of America. In the sovereign bond space, the US long maturity papers are benefiting these days from a strong sale of US treasuries this week, which is actually a sign that investors around the world are actually getting used to the idea that the United States will continue to spend, and well, that's life, we'll have to deal with it. The Japanese long maturity yields, on the other hand, were lower before the 20-year bond auction in Japan, but the fact that the 30-year JGB yield is now at and above the 3% mark remains a risk for global risk markets. So that is a place that you should be keeping an eye on if you want to see the red flags before potential global sell-off. In the energy space, the barrel of US crude continues testing the 200-day moving average to the upside, with softer US dollar certainly helping in the building of this positive momentum. And in the metals space, the price gap between the US copper and the rest of the world remains impressive. It actually helps boosting appetite for American copper miners, but it is bad for 1, the US industries, 2, for foreign miners export their copper to the US, and 3 for US inflation outlook. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.